Welcome back. You're watching Business Morning on Channels Television. Today, the Monetary Policy Committee of the Central Bank of Nigeria begins its two-day rate-setting meeting in the nation's capital, Abuja. At its last meeting in November, which was its last meeting for 2016, the committee maintained monetary policy rate at 14%, cash reserve ratio at 22.50%, and liquidity ratio at 30%. And most analysts are of the view that these rates will be maintained at the end of its meeting when decisions are announced on Tuesday. But let's get the conversation going around what will be dominating the discussions between or among the members of the MPC in Abuja today. And joining me on the program is an economic research analyst with FSDH Merchant Bank, Babajide Sholanke. Good morning to you, and thank you for joining me on the program.
Thanks, Harry. Thanks for having me.
So, good morning. So, FSDH was among the analysts that actually, put investment institutions that actually put out their pre-MPC thoughts. And you're saying that even though the committee will maintain status quo, maybe at this time an expansionary monetary policy will be appropriate. Why?
If you read the headline we mentioned, is monetary policy appropriate? There's a question mark, which is a question we're asking broadly. But if you check our conclusion is that they will do nothing, in the sense that they will hold all the rates the way they are. And it's understandable, because the overwhelming argument, that the economy right now faces, which have implications for social cohesion and social interaction, is economic growth. Economic growth is a fundamental problem the economy faces. And this is now what economic growth is even deceitful, because what we actually have now is economic recession. 2 quarters of negative GDP has been gone past. We have 3 consecutive quarters of GDP, which is negative. Of course, there are problems emanating from inflation rate, which is inflationary pressure from energy prices and from devaluation that has fully fed into the inflationary spiral. And we expect that by Q2 2017, we should begin to see a slowdown in inflation and begin to, really, by the end of the year, inflation should be lower than it was on the average for 2016. Exchange rate is still there, and it's still very, very evident. But economic growth is the key element. And unfortunately, the central bank faces a quagmire, a dilemma, because monetary policy has kind of reached a logjam. Because monetary policy, by implication, has short-term policy, short-term economic policy to influence, to affect aggregate money supply in the economy, such that the money supply in the economy is not inflationary, in terms that it's not leading to unstable prices that will impact economic growth. So fundamentally, we believe that economic growth is the key element. Economic growth is what will dominate, and monetary policy cannot solve it. The central bank will wait out the budget 2017 implementation. What the economy needs right now is a reflation. So we expect some policy coordination. The president alluded to that in the 2017 budget, and we expect the central bank to say, wait a while, because like I said, monetary policy is short-term. In the next 2 months, they will be meeting. Maybe between the next 2 months, we'll see what goes on with the budget passing by the National Assembly, was signed by the president, and of course there is still an international angle for monetary policy action, the upper market, which is the body, the MPC in the United States.
But it seems to be, like you said, it's a serious dilemma for the committee, because I know that the central bank, it seems as if the central bank has abandoned its inflation target, which was 9%, because right now we have inflation at 18.55%. So all systems go, and whatever it is, you hope that something happens from the fiscal side that will allow the monetary authorities to maintain the rates that it's kept so far.
Ares, maybe you could just say that jokingly here in the studio, said that the central bank abandoned its traditional objective for which it was set up, which is price stability, fundamentally. Price stability from 2 price elements: consumer price in the local economy, external price in terms of exchange rate. It's unfair for us to say that to the central bank. The central bank hasn't abandoned the inflation target, basically, but overwhelming forces the system, supersedes what the central bank can do in terms of trying to monitor prices, particularly consumer prices in the domestic economy, which is inflation. If you look at the monetary aggregates, in terms of monetary aggregates, means the available money is in the system, you see that it's gone past the target of the central bank set. So from that perspective, you can say that the central bank should further tighten, because that's a kind of a demand pull inflation tendency. But the economy is not facing a demand pull inflation tendency. What dominates inflation rate in Nigeria is of a cost push element. cost-push element emanating from infrastructural decadence, cost-push element arising from energy prices, which is beyond our control, which is determined in the international market, and of course the devaluation which had to be done because of inadequate external reserve to defend the value of the naira. So by and large, the central bank hasn't abandoned inflation, but there are forces which are driving inflation, which are cost-push elements emanate essentially from the fiscal policy environment. Fiscal policy environment meaning the federal government of Nigeria, and that's where everybody's hoping, praying, pushing and plodding the federal government that we need a reflection, we need an implementation, we need a more vigorous implementation of the budget in terms of capital expenditure build-up, in terms of engendering positivity in terms of the Nigerian economy. We understand the federal government dilemma in terms of limited or diminished, oil earnings. You understand? We understand that, and that has impacted its ability to be able to meet its fiscal policy obligations. And if you look at even the monetary aggregates, the federal government has borrowed, the growth in credit to the government in terms of from the banking system over 280% year to date as at October, which means the central bank is taking more money than anybody in the system, of course. But the money the federal government is taking is going into paying recurrent expenditure, actually, not into generating capital.
But you see, Babajide, it's still a quagmire, it's still a dilemma, because this also means limited options for the banks. Definitely. So the central bank does nothing or maintains status quo and keeps those rates. And we have the bank still telling us that, look, we can't give you, we can't borrow you at so and so interest rate because we have it at between 25 to 28%, and because of what we have coming as rates also from the Central Bank of Nigeria. So as a manufacturer, you can't get good loans because of the interest rates. As a private investor, you can't get it. As a small and medium enterprise, you can't get good loans at affordable rates as well. So what options for banks?
Yeah, for banks, it's even more interesting that you mentioned the banks, because monetary policy is essentially a system that is supposed to work through a transmission system through the banking system in terms of loanable funds. And, the bank's been an intermediation agent to take money from the surplus sector to the deficit sector. And again, it's unfair for us to begin to look at the banks from that perspective. The banks are business concerns that have shareholders, that the shareholders need profit, in as much as the bank needs to carry out other social responsibilities of generating economic growth via lending to other sectors of the economy.
And investing as well.
And investing as well. But the banks have been investing. Because if you look, like I mentioned, if you look at it from the monetary aggregate perspective, monetary aggregate includes broad money, which is the money that is available in the system, generally. And of course, it includes, it tries to determine again what is the net credit to the domestic economy, the net credit to the government, the net credit to the private sector. The central bank set benchmark for this monetary aggregate. And if you look at it, as of October 2016, the net credit to the private sector annualized is about 28%. Far higher than the about 14% the central bank have said. That tells us that the banks are actually extending credit to the economy. But however, the banks should have to be wary about the ability of the customers to pay back money in the face of increasing interest rate as propelled by monetary policy. You look at the monetary policy at 14%, and the bank, like you mentioned, like 28%. That's about double. So what's responsible for that? If you talk with most bankers and most treasurer of banks, they will tell you that, look, our fundamental problem, interest rate is one of it, because of the cost of money. Mm-hmm. But the fundamental problem that adds up to that margin that makes the interest rate, lending rate in the economy higher is because of these same cost push elements that have to do with the increasing cost of doing business in the system. And monetary policy cannot solve that. The central banks keep saying that. We agree with them. It's fiscal policy. The federal government have to step in. They have to step up to the responsibility. They have to help to reflect this economy. They have to engage more, in terms of with the private sector, and they have to give us critical infrastructure, which is a key element.
How will this also, the decision, whichever way they decide to swing, how will it affect the currencies market? Because listening to me this morning, I'm sure you still see there's a very wide gap between, the interbank OTC and the parallel market. The Bureau de Change operators seem to be, their own rate is seeming to be closing in now, maybe because of more dollar sales by the CBN to them. But how do you think this will affect the rate? Will it maybe lead to a further drop in the value of the naira?
It wouldn't necessarily do that, in the sense that, like I mentioned earlier on, there are three issues that would dominate this monetary policy committee meeting. The first issue is inflation. Like I mentioned, inflation, of course, we expect it to begin to trend down going forward. The second issue is the exchange rate. And the third issue will be the economic growth. You just alluded, we've talked about all of that. Let's focus on exchange rate. Exchange rate, what the central bank has been doing with its monetary policy, I won't call it monetary policy. The Central Bank of Nigeria, for almost 2 years now, the monetary policy has been tending towards a more exchange rate policy determination in terms of them ring fencing, protecting the value of the naira so that it doesn't over depreciate, so that it doesn't cause imbalances in the system. And the central bank monetary policy hikes over the years, and its other monetary policy tool, which is open market operation, has been geared, essentially towards attracting this foreign portfolio inflows into the Nigerian economy. And that's the reason why they've been jacking up the NPR. That's the reason why they've been using the OMO rates, we could get trending higher, so that we can, one, to help to achieve positive real yield on fixed income security because of the higher inflation rate. Secondly, to attract, foreign portfolio investors in the system because of the higher yields from the higher interest rate compared with the rest of the world. But like I said, that is not working so far. That is not working so far because most of the foreign portfolio investors and domestic investors still feel that the naira tended to be a little bit adjusted in terms of its valuation, and you can actually see that in the gap between almost 190 or 90 naira premium. So exchange rate will dominate. The central bank will hold rates at this meeting because it wants to hold that rate to attract foreign portfolio investors. It will not reduce that rate at this meeting because if it reduces that rate, it will lead to capital flight, to defeat its aim of ring-fencing the naira, protecting the value of the naira, and helping to increase the external reserves to defend the value of the naira.
So, Babajide, what's your lending rate outlook for 2017?
No, let me start off with this. Like I mentioned earlier on, a key objective of the central bank is to ensure price stability. Domestic inflation rate, external, which is exchange rate. We expect a trending downward inflation rate, like I mentioned, Ron, as we begin to grow. Not fundamentally because things are adjusted properly, but because of the base effect, because of higher prices or higher index in the previous period. And from mathematical computation, they should relax. Of course, higher food harvest, that because of the big component, about almost 60%, over 60% of the inflation basket is a food element. But of course, the other pressure from higher energy prices because of the increasing price of crude oil, which is a base for refining products, then the higher exchange rate at which the refined products are being brought in, and the possibility of a higher increase in the pump price of petrol. Higher energy prices, you were talking about energy, electricity distribution companies. If you look at the model for which the template for which they use to compute the tariff, which they charge, of course, all the models in terms of inflation rate, exchange rate has gone haywire, and they're still expected to work on that. So they need to adjust it. They've been talking with the federal government, the Ministry of Power, to adjust that. So there is inflationary pressure from all of that. So going forward, we expect the MPC, like I said, it will be difficult for us to commit to that. Like I said, MPC must be viewed. I started with the definition. MPC must be viewed in the context of what the monetary policy is. Monetary policy as short-term economic policy. They will meet in the next 2 months. I do not expect tariff in terms of for power to be increased in the next 2 months. Of course, maybe we get some semblance from what Donald Trump's activities are, then they can have an understanding from international dimension. But generally, the cost push elements are still there. That's what's driving the inflation rate. And the cost push element will always make the rates higher than what they should be.
Babajide Sholanke, Economic Research Analyst with FSDH Merchant Bank. Thank you so much for coming on the program this morning.
Thanks for having me.